Good morning, everybody. It is Friday, January 4th, 2019. Happy New Year. And do you have a job today? So we got a jobs report today that kind of blew the roof off the joint. 312,000 jobs in December, which was a huge jump from the prior month. You can take a look at this BLS chart and see that you get some bouncing around here. And we're going to start real quick. We're going to really get into this jobs report. I want you to take a look at these red lines. I can't find the annualized chart just yet. I know Bloomberg has it, and I'm sure somebody else is building it. But this is a very good year for jobs, just like 2015 was. I would expect next year to be down in this 2016-17 range for a couple of reasons. One, we're running out of unemployed people, which is a great problem to have. You know, there are just some small headwinds to the economy right now. And these small headwinds, and Dave and I are going to talk about this. Dave Zanoni is on today. Should be on most of the rest of the time. The reasons the people are using to narrate the correction in the stock market may or may not be great reasons. I was talking to Dave offline, and I suggested that the economy is in equilibrium right now, and I think that there is probably a pretty good chance that we get a huge rebound here in the first half of the year for the stock market, especially if there's some sort of detente with China on trade war, because shrinking global trade faster than it would naturally happen as supply chains move could clearly be a shock to the economy. But there's lots of moving parts, and we're going to talk about why the stock market moves the way it does a little bit, why some of these narratives are great things to talk about, but don't necessarily always really correlate to why stocks are moving. So we're going to take a look at a lot of things, and we're going to finish up with some oil. And somebody submitted a question about Tesla. So we will see. I do think bottom line is we're going to get more volatility this month, and we'll see if the support levels that we tested a few days ago really hold on. I have a chart for that. There's a chart for everything. And I will tell you, if you remember your science class back in 7th grade, when your teacher started giving you a really cool lab work to do, data and charts and statistics, anything can be manipulated to tell you what you want to hear. So the question becomes is how do we interpret the data that we get? And avoid letting the narrative sway us, avoid letting our emotions sway us, avoid letting our need to have our self-validation sway our analysis. There's a local talk show host who I don't really listen to too much anymore, but he's done some really good local analysis of politics and business and whatnot. He fills in for Rush Limbaugh once in a while, a guy named Mark Belling. And he has identified correctly, in my opinion, that rationalization of facts and what's going on to create self-worth through self-validation is probably about the second or third strongest drive in people. You know, the strongest drive is survival. For a lot of folks, the second drive is procreation or sex, and then the third one is self-validation. You know, what is my role in the universe? You know, the great philosophical questions. And as we seek to answer those questions, we rationalize a lot of things. So I would challenge everybody in 2019 to take a step back from your normal perspective and try to find a way to analyze without bringing yourself into it, right? Analyze things based on the facts, based on other people's perspectives, and history, and try to find out if, our views of the world are skewed by how we're brought up, who's around us, how we feel about ourselves, and how our emotions work. And there's a pretty good TED Talk out there that I'd encourage you to find somewhere. I have the app on my TV. But there is a data scientist who pretty much convinced me that emotions are in large part responses to uncertainty. And as we have more certainty, we are less emotional and go about our happy lives. And as we have less certainty, we get more emotional. And I think that nothing is, a better example of that than how people fall into love, out of love, and how they handle everything in between. So when you're falling in love, super emotional. When you're falling out of love, super emotional. And then that in between phase, when you're just going on vacation together and cooking dinner at night, that's this is my routine. And I don't know there's anything bad about routine. You just have to recycle the love every now and then. But I think that if we control our emotions this year, there could be some outstanding opportunities. And folks who are buying stocks right now in certain beat up high quality companies, I think that you're going to have a pretty good a bloom of apple buds at the end of the year. So there's a hint for something we'll talk about later on. So anyway, back to the employment number. Great numbers. Dave covered in his piece that we'll get to soon that the wages in the United States grew at a little over 3% last year, 2018. Somebody's beeping in. I don't know who that is. Oh, that's Bloomberg. Bloomberg wants to talk to us. All right. I thought that was your music, Dave. I was like, Dave, what are you doing? You have like a walk-up theme? Are you coming up to bat? So yeah, Dave, jump in here a little bit. So Dave, wages went up last year a little over 3%. You pointed out in your article.
Correct.
That a second. Inflation's only just nudging up to 2%. So that's good, right? There's a small increase in wages, nothing that's hyperinflationary or big inflation, but that adds to people's standard of living. So I would take that as a really good year for wages and employment, wouldn't you?
Yeah, definitely. Yeah, I think once you have very low unemployment, a lot of people are working. You've got people getting raises, where you see the income increases. People feel good about their situation, and they're going to spend money. Basically, you're going to see that working its way into the economy. So I know there's a lot of caution right now regarding tariffs, interest rate increases, and everything. But I don't think we're going to fall apart, right away, especially not in 2019.
Yeah, and I actually agree with that. I have that hashtag out there, the hashtag Crash 2020, and it's as much a warning as it is a prediction. I think I really do believe that with good policy, and one of the articles that I have coming out is probably next week, is a policy will set the stage for a rally or recession in 2020. And I think that's what it's going to come down to. If the Democrats try to sabotage President Trump because they know that a bad economy means a Democrat would win, one, I think that's unethical. But two, I could see it happening. On the other hand, the Democrats and President Trump are certainly aligned on an infrastructure bill, which we desperately need, not as stimulus in any way, but really just because we need a lot of infrastructure rebuilt over the next decade. So we might as well start to get on it and try to find a smoothing path to offset the gradual, retirement of the baby boomers, because that's going to be a drag on the economy. Not a huge drag, but a gradual drag on the economy for a long time until it's offset by millennials completely. And an infrastructure package that's forward-looking, looks at water resources as well as the electrical grid and roads and bridges, which is, what always gets talked about, could be a big deal. So if they come to an infrastructure agreement where that spending starts next year, that would be pretty awesome, because the infrastructure spending from the Great Recession, from the shovel-ready stuff, that's just ending now. All those projects are finishing up in 2019 for the most part. I see it around Milwaukee. I see it around all these other states that I drive around. You see that they're in the final stages of road projects all over the country. How many of you are sick of orange barrels? I know that I am. The bridges, a lot of bridges have gotten rebuilt near me and drive across country, and I have some of these great pictures that eventually I'm going to do a gallery site just of my travels. May or may not interest anybody, but I got some good pictures. I'm going to buy a better camera, but it's probably time to get ready for the next leg of infrastructure spending, and hopefully we do it smart. So in any case, going back to jobs, we've talked about 500,000 millennial men aren't in the labor force, so technically not counted in the labor force. So if we could get them working over the next several years, I think that would be great. I've told you the story. It was in one of my blogs. The 31-year-old or 32-year-old millennial guy who literally lives in his parents' house, spends most of his time in the basement, although his bedroom's upstairs, I hear. He wanted to do a documentary on the Dakota Access Pipeline, and he can't find an editor. And we had a discussion, and he ended up telling me, well, capitalism sucks. I was like, oh boy. And I wonder how many of those guys are out there who are disaffected for some weird reason, that they're of the notion that socialism is a better path. I've taken a look at some of the stuff going on in Congress with some of the freshman Democrats. This woman from New York, Cruz, right? Ocasio Cruz. I think that we're going to have some interesting times watching her. But in any case, going back to the jobs, if we can keep jobs in this range, all right, no huge drop, but replace the boomers who are retiring, and then try to get 500,000 millennial men into the labor force, that would actually be full employment. So we're getting very close to full employment, to the point where if the slack in the labor force, and think this through, I don't have a good chart for this just yet. I didn't pull it up. It might actually be in here. If we get 500,000 millennial men into the workforce over the next couple of years, that's probably going to be just enough to offset retiring baby boomers. So where do we get growth in the economy without more employees? And I think it's a pretty interesting question. What do you think? Where do you think new employees come from, Dave?
We have college graduates. That's a good source right there. So that's where you're going to see the millennials and eventually Generation Z after that.
Yeah, we're right on top of Generation Z, aren't we?
Right. And you may have some people that have been sitting at home. You have working mothers could be going back into the workforce, or even fathers in some cases, who were taking care of children. And as they get older, these parents will get back into the workforce.
What do you think about maybe we could cut a deal on some of the immigrants? Maybe the Dreamers. That's 1 million people.
Oh yeah, that's definitely a source. That's a good point. Mm-hmm.
So I think that we're getting to the stage in the cycle where we have to ask very serious questions about how are we going to have growth in the economy. And I don't want to make this political, but I think people need to think about I don't know if this is up to date. I think people need to think about labor participation rates And how do we grow the economy? You can't grow the economy without more employees, for the most part. Oh, what the heck? This should be an easy one to pull up. There you go. This is pretty. Oh, there you go. Pretty nice. All right. So, Calculated Risk is a great website, by the way, if folks haven't used it. So when you take a look at labor participation, topped out in the 90s, and what is that marked by? That is marked by the boomers and the rise of the two-income household, right? So part of that was the boomers' desire to put money in their pocket and live it up. Part of it was women getting educated into the workforce since World War II. And then it fell pretty much in this century. And the big drop came out after the Great Recession. A lot of forced retirements, a lot of those people never coming back. So are we going to see a range up here around 2/3 of the population working again? I don't know. Maybe. Only because the demographics over a very long period of time will drive us up there. Why? Because you're going to have so many people who are older when they finally die. So we're talking 30, 40, 50 years, I think, before we see, I'm not wishing anybody dead, but I think it's 30, 40, 50 years out before we see these numbers. This number right here, see how it kind of plateaus? And think about technical analysis. When you get these plateaus here, what does that represent? Support or resistance, right, Dave?
Correct.
So I think that the support and resistance, I don't know what the article says, but he's pointing to the spot where I would point to. So I haven't read this article, but I would think that we can get these 500,000 millennial men and a few million per year immigrants. We probably get to that point where we're really close to full employment. So we've got 63% of the people working right now, and probably 64% is about as high as we're going to get. Again, look at that plateau there. I don't think we get this. This is the boomers. We don't see this again until the boomers are gone. That's 30, 40, 50 years. That's a process. And again, not wishing anybody dead. It's just, we die. Mm-hmm. So we're probably within 1% of full employment. I mean, that's a big deal. So that's where inflation could kick in, is if we start getting closer to this, get another 3 million people employed. That's about maybe another 1%, I believe, of the population. Once we get 3 million more people employed, which would be next year, is about when we would get there, towards the end of next year, maybe into 2020. Then we're at full employment. And that's when I think a year or two from now, inflation could be a little bit of an issue, just from the standpoint of labor inflation, labor wage inflation. So we can kick that around in a year, I would think, as we keep an eye on those numbers. So this is the chart that I wanted to get to. This is a great chart. We have as many people looking for work as there are jobs. And in fact, there's probably more job openings, and I think this happened 3 quarters ago. The line crossed. Job openings to unemployment. There's more people unemployed, technically, than there are jobs available. And of course, this gap could represent the missing millennials in the workforce. So anybody out there who wants a job can get a job. Might not be the job they want, and they might not be qualified for a lot of the jobs, because a lot of the jobs out there are healthcare or engineering related. So I think and it doesn't mean engineer like you're building a skyscraper or a bridge, but building level engineers, people who handle the mechanicals in a building. There's a lot of jobs out there that require a 2-year either apprentice program or degree. And I think that the people who aren't employed and they want $60,000, $70,000, $80,000 a year jobs, even $100,000 a year jobs, and I tell you what, I would encourage everybody that doesn't have a 2-year degree, because that's most of the people who are unemployed, people who don't have any type of degree or training. Go spend 2 years getting that training somehow. And there you go. You are automatically pretty much in the middle class at that point. So a lot of good things happening in the economy. Now, that doesn't mean that everything is great. Some of the numbers haven't been so good, right? ISM numbers, was that yesterday, Dave?
Correct. Yeah, we did see there was a slight slowdown. Looks like the November report showed 13 out of the 18 industries showing growth, whereas this recent report showed 11 industries showing growth. So there was a little tick down, but yeah, it's caution. It could be trending down over time, but I don't think it's going to be. We're not rolling over right away.
Right. So, it's one of the things that I would kind of point out. One of the sectors that saw a slowdown was housing, correct?
Correct. Yeah, I think that's a good barometer for the overall economy. And eventually, you usually see a sharp a drop off in housing starts before a recession takes place, and we're not seeing that yet. So that's going to be a key thing to watch.
Okay. Well, so let me throw out kind of an alternative view on housing.
Mm-hmm.
I know and I know everybody knows a lot of contractors. What is the big complaint from contractors right now?
I'm not sure. I don't know. Okay.
Can't find people to work.
Oh, yeah, right. Okay.
Right? Mm-hmm. So you've got these 500,000 millennials who are unemployed, but none of them want to go help put up a wall, help build a house. And we know that timber is expensive, maybe an investment idea. So we have expensive raw materials just because there hasn't been a lot of investment in the last decade into those raw materials. Plenty of trees out there, but it's really a kind of a tariff issue. The timber went up, but a lot of the other materials are a little bit more expensive and harder to source right now. But the main one is employees. So if we want housing to grow, again, we have to address the labor issue there. They can't get people to put up more buildings fast enough. I hang out with a guy here in Wisconsin, poker player, met him through poker. Once again, I'll plug that form of entertainment. I want anybody who's thought about playing poker and has money to spend on learning to join me at a poker table, please. Come on, Dave. I mean, that's kind of funny, but the housing starts, I think, are largely down, not just because of interest rates being a point higher, but I think because it's just hard to find the labor to build the houses. I know, and I'm sure everybody else who's in the industry knows, that the backlog is actually pretty big. There are people who want to build houses, and they're being told can't do it right now, can do it maybe in 3 months, can do it maybe next summer. So I would expect that come summertime, you see the housing numbers jump back up, right? So I don't want this thing to start. So transactions have been trending down for a few years, but this is pretty big. I think we're near the bottom of this housing correction, and it's a weird correction because prices haven't really dropped. They've just kind of plateaued, but we're not getting housing starts. Sales have fallen off, probably due to the slightly higher interest rates. But we know that wages are going up. Again, what does this point to? To me, it points to equilibrium. I think the economy is in this weird place that we don't see very often, which is it's about right. The economy is about right. So the stock market is trying to tell you that the economy is in hellish shape. I don't know. I covered my futile forecast last week, and I'll be publishing it later today or tomorrow. I think that the first half of this year is going to look pretty good, and if policy is decent, between trade and the Fed, um, I think that we're in for a pretty good run here. And that is not something that I've been saying the last few years because certain things scared me. And there's a disconnect all the time between the economy and the stock market. Sometimes the stock market is forward looking, sometimes it's backwards looking. And right now, I think it's trying to be forward looking, and the narrative is that things are going to get worse. But I don't see that. So when we take a look at Dave's article here, and I encourage everybody to read it because there's some important data points in here and some things that he talks about. Dave, why don't you give us a synopsis of this?
Sure. So basically, I'm looking at the biggest factors that are going to mostly impact the economy and carry over to the stock market. So I used, the yield curve has always been a long-term indicator. Typically, the yield curve inverts. When I say yield curve, I know there was some talk of it recently, where people were comparing the 3-year to the 5-year, but the traditional comparison when we talk about yield curve is really the 2-year versus the 10-year. So when the 2-year interest rate rises above the 10-year, that's when the yield curve inverts. And we didn't see that yet. That's the point I made there. And typically when we do see the yield curve inversion, interest rates are rising. And it's usually towards the peak of the economy. And typically a recession will take place anywhere between 6 and 24 months away. It's usually longer than the 6 months. That was one of the ones in the past. It could be a year out, year or two out. So that's something you want to take a good look at. And that's where the interest rate increases are going to get us closer to that yield curve inversion. And then I look at housing that I mentioned before. That's very important because there's so many other factors involved with purchases. That's a big purchase. And it also leads to other large purchases like appliances, HVAC systems, furniture, TVs, anything else that goes into a house. So that's when housing is strong, the overall economy is going to remain strong because there's all these purchases going in there. So now that we have the unemployment situation in a pretty good spot right now with low unemployment, rising wages, people can still afford the houses. The average mortgage rate, it's just above 4% for a 30-year mortgage right now. So that's still pretty affordable. Anybody who bought houses in the 80s knows that, the interest rates right now are a lot better than the double digits that we saw back in the 80s.
So my dad tells a story about the first house he bought in 1979.
Mm-hmm.
We had been living in my grandparents' flat. We rented their top of their duplex. My parents bought a house in 1979, and I don't remember the exact interest rate that they paid. And I'm sure some people in the audience will recognize this. Go ahead and throw in the chat interest rates on houses that you bought around 1980. I think my parents' interest rate was like 18%.
Right.
And so that made the houses very affordable. And here's something that I think maybe people should pick up on. When interest rates rise and housing prices flatten or drop, that's a great time to buy. Why? Because we know the interest rates will come down eventually. So if we would ever see mortgages back at, and we will eventually, but at 7, 8, 9, 10%, and people say, oh, the interest rate's too high, well, negotiate the price of the house down. And then as interest rates come down, refinance. That's what my folks did. Yeah, so Dave throws out, so some of the numbers, 16.75%, 1981, 19.5%. So I was probably right on there, Dave, with other Dave. I said my parents, I think their interest rate was 18% in 1979.
Right.
So, we're at 4% right now.
Mm-hmm.
Again, do we need 2 and 3% mortgages to sell houses? I don't think so. Not if wages are going up net of inflation by over a point a year, and employment is so high. In Milwaukee, and a dozen other cities I've been to in the last couple of years, it seems to me, and I know that the statistics actually do bear this out, that millennials are buying houses later in life. Why? Because they like hanging out downtown when they're young before they have kids. So a lot of them are renting near city centers. and it makes a lot of sense. I did I kind of do this regularly because I think about strapping it on one more time and moving back downtown in Milwaukee. Although I just love my little suburban place, um, and I compare buying a condo versus renting, and then investing the difference. And there's always this argument about buy or rent, and the reality is, and I proved it, is that if you rent and legitimately invest the difference, two equivalent places, that's got to be apples to apples. But I've rented for 15 years in a suburb of Milwaukee, Muskego, Wisconsin, and my rent has gone from $1,200 a month to about $1,800 a month over those 15 years. For me to buy the place that I'm in, over those 15 years, I would have started when taxes and maintenance and everything are figured in, at probably, and I just did this exercise, at around $1,800. So for 15 years, think of it as a triangle. 1,200 in rent to 1,800 in rent. That's your one line on the slope. And then I'm just getting to the point where the cost of had I bought 15 years ago. So I got to save $600 a month for a year, and then $550 a month for a year, and then $500 a month for a year. Take all those numbers in there. Any life insurance salesman will kind of understand this chart that I'm trying to draw in the year without showing you. Because I invested all that money, and I made way more than if I had just had the equity in the house. Because the equity in the house went up, equity in the house came down. Now the equity in the house is back up, and I could own the house and have a $400,000 asset, or I could have $1 million in a retirement plan. I took the $1 million in the retirement plan. So, there is an argument for renting and investing the difference. Of course, when most people rent, Dave,
Yep.
they invest the difference?
Probably not. I mean, some people rent because they can't afford a house. So, multiple factors. But
well, for sure that, right?
Right.
I mean, but people who are going to the city centers and paying the high rents versus buying the condos, they're probably better off paying the rent if they invest the difference. Because, for example, for $1,800 a month in downtown Milwaukee, and I don't know what markets are around the world or around the country, but for $1,800 here, I get a 2-bedroom, maybe with a den, 1,200 or 1,300 square foot place, 2 bathrooms, maybe a bath and a half. What I get in the burbs for that is 3 bedrooms, full basement, attached garage, an acre of land, 2.5 baths, 1,600 square feet. And, if I wanted to buy that, depends on where you are, right? So if you're in the city center or the burbs, you're probably paying quite a bit of money. And if you're in the in-between areas, urban, semi-urban, but not quite suburban or city center, you probably get a deal there, right? So that's where a lot of the renters who can't afford higher end live, right? They're in the less expensive places. So as I say, you have to have the apples to apples comparison. But for that 1,800, I can rent downtown. But that same unit, if I want to buy it, I'm looking at 400-ish. So you calculate the mortgage on that, almost the same 1,800. But then you got to put in the property taxes, which in Milwaukee are high. Probably another $400 a month, and then you have to pay your condo fee, which is, depending on the condo and what the amenities are, anywhere from $200 to $600 a month. So now all of a sudden you're spending an extra $1,000 on taxes and condo fees and some of the maintenance, right? So again, it's always comes down to the math. And I think the millennials are doing those equations. I don't think they're investing the difference. I wish they would. That would be great for the stock market, and they should be investing right now on this correction. A year ago, I told the millennials to save their cash until the next correction, right? And I probably should pull that article up and write it. There you go. My best advice for millennials right now: This was in March, after the market already started to rally back. I told him, I said, save your money. Save your money, wait for the, wait for the next correction. I told him, max out the retirement plan contribution, but put the money in like in a money market fund. If millennials have been saving their cash for the last year or 2 or 3, and they were investing now, and you can buy Apple, you can buy Amazon, Google, all for prices from 2 years, 3 years ago, right?
Mm-hmm.
So, we take a look at all these cycles and we ask why, given all the things we talk about in economics here, right? Why does the market really move the way it does? And it has to do with supply and demand, just like supply and demand controls everything else, right? So if there's more money going into the market than coming out, market goes up. If there's more money coming out of the market than money going in, market goes down. And, we covered a lot of that, covered the institutional buyers. We know that institutions are in gradual drawdown because most of the institutions are pension funds. And that this is perpetual. This is never, ever going up ever again. We are never going to see pensions in net accumulation ever again. Why? Because the younger generations don't really have pensions and the older generations are drawing. So this is a net drag on the economy, on the stock market that's not permanent, but probably for the next 30 years, right? So as far as we're concerned, 30 years is permanent. The Fed's QT is $50 billion a month. That amounts to about 3% of GDP, almost 3% of GDP. And we mentioned this off air. I mean, what would GDP be if there was no quantitative tightening? Would it be 5%? 6%? I mean, that would be ginormous. And that is largely tied to energy, which we're about to talk about. And why is it tied to energy? Because now we're a net exporter of distillates. And we're sniffing. It won't happen for another year, but we're sniffing being an outright exporter of energy. By the end of next year, we will be a net exporter of energy. We will officially be energy independent. Now, that doesn't mean we're not buying energy from Canada, Mexico, and other places, but what we buy is less than what we sell. Because LNG, liquefied natural gas, going up. Company that we included in our portfolios, in our retirement income growth portfolio, there's a company involved in that. But because we're going to be energy independent by the end of next year, think about that. That's a huge inflow into the economy that we haven't had before. So I'm not saying that the Fed has to stop quantitative tightening, but I think that they ramped it up a little too fast. And I think if they pulled this back to 20 or 30 billion and told people, hey, as circumstances change, we can ramp it back up if we want to, I think that'd be great. So Fed Chairman Powell said today, did I cover it? There you go. Powell gives averages an additional boost. He said we were prepared to adjust policy quickly and flexibly. Why would that be?
Yeah, I think if he sees things declining, or if he sees inflation lowering a little bit, he may pause. He may see less than expected raises.
Right. What else?
Or if it could go the other way, if he sees things really heating up.
Right.
Incomes increasing more than expected. Inflation on, let's say oil goes back up, causing inflation with prices on food and other regular items that people have to purchase. The PMI going up could cause, they could raise more frequently than the 2 times that they're expecting in 2019.
Well, right. Okay. And then there's, Trump has browbeat him on the trade issue. So what if we keep having the fight with China and the Fed backs off to let us keep pushing them, right? Mm-hmm. It probably makes a lot of sense to keep pushing on China unless they come in with a really good deal, because our Federal Reserve can come to our aid. Mm-hmm. So if we need that $50 billion a month back, the Fed can give us that $50 billion a month back, and we can say, look, China's still not playing nice. We'll wait them out.
Mm-hmm.
And maybe there isn't a deal in the next 2 years with China, and the Fed is signaling right now that they understand that they might have to change policy. So what has Powell just reversed? He has just reversed the whole autopilot statement that he made in December, which when I was watching TV when he said it, I just about fell off my damn chair. Oh, we're just going to leave the quantitative tightening on autopilot. I mean, I almost died. All he had to do is say he's going to be flexible. So 3 weeks later of Jeffrey Gundlach and Stanley Druckenmiller and everybody else telling him, dude, you need to tell the markets that, hey, if something goes wrong, you'll help. That's all he had to do. So the Powell put just got created today because nobody was sure if there was a Powell put. And in December, we were convinced that there wasn't. And now all of a sudden he's at the New York Economic Club. Is that where he was? Oh, no, American Economic Association. And he's saying, oh, yeah. There's a Powell put. There's a Powell put. Yeah, we got that. Oh, well, swell. What does the market think about the Powell put? I don't know. Is the market up? A little bit. 655 points. It's all the give back from 2 days ago. So, and then what is the? I hate to use Yahoo here, but it's where I have it set up. What's doing really well? Market's up almost 3% today. Look at tech, screaming. Where have I told people to put money on these pullbacks? Tech and energy and high quality stuff. Tech stocks. There you go, folks. Here's some of my favorite plays. Antero is finally rolling. Centennial, Chesapeake, 7%, 6%, 2%. That's a laggard at 2%. And the thing is, this is the sneaky one, folks. These guys are going to ramp up production huge in the middle of the year. But because their backwards-looking numbers don't tell you that, because everybody goes, oh, look, their numbers aren't as good as everybody else's. They don't actually read about what the company's doing, right? Jim Rogers, if you read what the companies are actually doing, you'll know more than everybody else. That's true. Nobody knows the Centennial development is going to, just a exponential growth the next 2 years, starting in the middle of the year when the pipelines come on. Bicentennial growth development. Continental Resources rising with the price of oil. Again, it's probably the first one I get out to. And once we get to the peak oil plateau and oil prices are 70-ish, right? 80 would be the high end, I think, for now, unless there's a war. Then these guys are probably done rising, right? Then they lock in and they hedge, and then now you look at, then they're probably fully valued at that point. Devon Energy, though, another one of my favorites. These guys just they were on that list. So subscribers to the investment letters, whether it's fundamental trends or margin of safety investing, I showed a spreadsheet that I did, and I could probably pull it up here again, that showed the companies that had huge new stock buybacks. Devon Energy was on that list. So I will actually pull that up for you right quick, because that one I can get to pretty easy. So I have this ranked by shareholder yield because that's one of my favorite measures. And you'll see that these are all companies. Look at these. Okay, these are two columns you want to look at. Stock buyback quarterly, then trailing 12 months. So Qualcomm, which is a company that we have in our dividend income growth portfolio, retirement income growth, buybacks over the last year, $22 billion, but almost all of it came in the last quarter. So a lot of these companies, huge fourth quarter increases in buybacks, which I talked about. Now, rank this here by sector, and you can see a lot of the banks buying a ton of stocks back. They're normalizing. The banks are normalizing. I don't think that means they're great for long-term growth, but some of them to pay out big dividends are certainly pretty interesting. And let's see here, should be this screen. Oil and gas EPs. Take a look at some of these. Concho I haven't bought yet, but they're on the list. Look at these companies, oil and gas companies. Huge new buybacks. Occidental, one of our babies, right? Devon Energy, one of our babies. Marathon Oil is pretty good too. Some pretty interesting stuff going on. So with that, let's jump into oil. I know everybody likes to talk about oil. So this chart, commitment of traders. If you don't have a bar chart or follows that, I think it's Futures Exchange Chicago. You get this chart, important chart. It shows you what the big traders are doing, small traders are doing, the hedgers, and you can see the relationships here. So as the price of oil went up, right, the large speculators rolled it up, and then large speculators started to sell. Price of oil went down. More hedging, less hedging. So the swap dealers changed direction. Small speculators, not that important, but they big time changed direction. And they might have been the marginal buyer seller here. So the small speculators, little hedge funds, might have been, the day traders might have been the one that drove oil down a little further than maybe it should have gone. Your non-commercials, your commercial managed money. Oh, I looked at the wrong chart. I'm sorry, wrong line. But your non-commercial managed money. Yeah, I had that right. You take a look and you see the swap dealers. They really, changed the price of oil. So they told, again, the narratives. Listen to these narratives and then decide if they're right or wrong. We know that basically OPEC produced more oil to offset the Iran sanctions, and the Iran sanctions weren't as tough as we thought they'd be. So there was a little bit of overhang in oil, less than 1 million barrels a day, okay, like 800,000 or 900,000 barrels a day, supply exceeded demand. Yet that crushed the price of oil. So let me ask you this. With OPEC cutting oil production by at least 1.2 million barrels a day starting in January, and they're basically signaling in the last 2 days, that they are going to cut production by more than that, led by Saudi Arabia. What if they end up with a cut of 1.5 million barrels per day? And shale production is flat in the first half of the year. And why would shale production be flat in the first half of the year? Because there's not enough pipelines to increase it. Pipelines are coming, but not until the second half of the year. So could we see this go back up to about this area? I think this is it. I think that this is the area where the price of oil is going to be for the better part of a decade, again, until electric vehicles take off. So you're going to see this rise in here somewhere. Could it go higher? This seems to be the point where there's pushback, right? Do they break through it? They could, but probably in the second half of the year, shale production increases again. And if the economy is good, we'll need it. So I think you see these prices, $80 is probably the high end for WTI. And I think that part of that's going to be driven a narrowing of the spread between Brent and WTI. So we'll see, but probably get back up to here. And then you ask yourself the question, who makes money when oil gets back to $70, $75 a barrel? Right? It's all those companies that I just showed you. Permian, more Bakken, and Stack Scoop. Permian. Permian, Eagle Ford. Permian, Permian, Permian. Get the drift? All right. So what do we know about shale? Well, if you take a look at the Financial Times, and folks, I'm telling you, Financial Times and Bloomberg and Wall Street Journal, you ought to have all. If you're investing your own money, you spend the $100 a month to get those 3 publications. That's just the way it is. Spend that $100 a month. Those 3 publications give you basically all the information that you need as far as raw data. And then it comes down to, okay, how do you analyze it? I read this stuff 50 hours a week, so I know you're all doing real jobs or retired and you don't want to do this full time. So I try to help out, and Dave tries to help out. But understand the shale industry is they've become very profitable. Let's see here. There you go. U.S. shale groups reach self-financing milestone. Ed Crooks is a good guy. Follow him on Twitter. So for years, U.S. shale didn't make any money, and that's still part of the narrative from the shorts because they were borrowing more to produce more oil. And that recently changed in the last couple of years because Wall Street said, look, you guys got to pay this money back someday. So there was the big shakeout in oil companies, a lot of bankrupt oil companies, a lot of mergers. The mergers still going on because they have to be cash flow positive now. Why? Because they have debts to pay, and that is in the face of we know we're in the early innings of the end of the oil age. So these companies with high balance sheet with high debt balance sheets, they got problems still. So when we select companies, we want companies with good rock, right? Good places to drill for oil. And also good balance sheets to the point where they have great shareholder yield. And why is great shareholder yield important? Right? Take a look at these oil E&Ps. They're just starting to go positive on shareholder yield. What is shareholder yield? That is the rate at which companies decrease debt, buy back shares, which is money back to shareholders, and really and reducing debt is money back to shareholders too. It's just the debt holders, right? Money back to debt holders, and then dividends. So these companies, if you take a look at these charts from a year or 2 years ago, huge negative numbers. These companies are all at inflection points. They're just starting to give huge amounts of money back to their shareholders and increasing their dividends. So companies that weren't paying dividends just a year or 2 ago, starting to pay dividends and buying back shares, right? Occidental, I'm telling you, is a better company for you to own than Exxon or Chevron. Exxon and Chevron have massive problems with the structure of their rock, their portfolio of assets, as well as the fact that they have to pay off billions and billions in debt. And they're going to have a hard time doing that because they need to develop the assets with the money they have on hand. So how do they pay down the debt? It's going to be tough because they have to do it in about a decade. They're not going to pull it off. Exxon's in big trouble. Chevron, has got some problems too. If they were smart, they would spin off their MLP, their midstream and downstream assets. And I think that's coming, and I actually have that in here. Go figure. So shale, a lot of shale, particularly the Permian companies, became cash flow positive recently. I just showed them to you. And that's important because the cheap financing is gone. So when you hear the IEA say that the United States is going to be exporting or producing 17 million barrels a day by 2026 or whatever they said, I'll tell you what, I don't think that's true. I think we increase production 2 to 4 million barrels a day over the next 5, 6, 7 years, but then we start to run into physical barriers. And that's easy to see because all but 2 of the shale basins are starting to already run into those barriers, maybe 3. But all the other shale basins, Niobrara, even Bakken, you run into all these engineers, and they will tell you, and their articles are out there in the industry publications. If you're not in the Permian and maybe the Eagle Ford and the Stack Scoop, you got problems, and they're coming quick because the oil isn't getting super cheap in those places. Permian oil is still pretty cheap. Eagle Ford is pretty cheap. Stack Scoop is pretty cheap, but all the other ones not so cheap. They're getting more expensive, even with the technology offsets. So you have to be a picker here. A couple of the ETFs are good at it, but XLE, which is Spider XLE, heavy in Chevron and Exxon, I'm telling you, stay away. That will not be a leader in the future. Globally, we also know that financing is a problem. And probably, if the United States really wants to be a big deal in oil, we would tell Halliburton, Schlumberger, and Baker Hughes not allowed to do fracking anywhere else. Really, I mean, we outlawed exporting oil for a long time. Maybe we should outlaw our companies from sharing shale fracking technology. It's kind of already out there, but maybe there's some handcuffs we could put on them. But financing is a big deal, and other places are not getting all the financing they need. Why? Because Wall Street is focusing on, and global financiers are focusing on the places with the fastest payback. And right now, the fastest payback is in the Permian, especially when those pipes come on in the second half of the year. So these companies that I'm in love with, not really in love, but Permian, and Concho. I think Concho's a good company too, and a couple others. I'm going to put out that Dirty Dozen stock list maybe this weekend, probably early next week. These are companies where imagine what kind of money they're going to make as they increase production into higher oil prices, and that oil gets exported for processing into gasoline, or it gets the refiners here do it, and then they export the gasoline. Either way, we're exporting gasoline, so diesel. Although the differentials in diesel are pretty interesting. There's a guy in the comments section in a lot of these Seeking Alpha articles. His name's Johnny something. Anybody recognize Johnny something? Well, he pointed out some interesting stuff. Johnny Cage, yeah, Johnny Cage. Johnny Cage said some interesting things, and he pointed out, let's see if I can find him here. He's not in this one, but he's in one of Baseglio's articles. I don't have a comment mark. There's no comments up right now. But Johnny Cage pointed out the differentials on diesel, and that was interesting. So there's some interesting things coming up in the distillate market. In any case, we know that we're probably going to see a big rally in oil now. If you haven't been buying those stocks, I would jump in. If you do own those stocks, hold tight. I know everybody likes to ask me about buying calls. I think that you need to be a swing trader if you're buying calls. You have to be very attentive. You have to have some technical trading skills, so it's going to be volatile. And I don't know what it looks like towards the end of next year or end of this year. We could see a replay where did my chart go? We may not see this big of a drop, but let's suppose the price of oil gets to 75 by July, which I think could happen. In fact, I'm predicting it will happen. I think the price of oil rises 50% in the first half of the year, but then it's going to give some of it back. So that's maybe comes back down to 65. But we're going to get oil back in this range. It'll come up, and then as summer goes away and pipelines come on, right end of drive season, going into winter, pipelines come on, more projects get developed, oil probably comes back down again. Does it come all the way back down to 50? I don't think so, but maybe. maybe we just need to be oil traders now instead of oil investors. And I think that I'm leaning in that direction. So let's ride this rally up, USO and XOP, and then our favorite oil stocks. This article I summarized. It's almost done. Why oil's going to rise. I talk about the perfect storm that crushed oil. Traders talk their book. There actually is no oil glut. We just talked about that. Oil demand is rising. Shale production will be flat in the first half. Shale's just starting to hit physical limits. Problems with should be constraints with U.S. refining and pipelines. Saudi Arabia cutting production. Trudeau's revenge. What is Trudeau's revenge? This is Trudeau's revenge. Alberta production cuts are pretty big. They just went into effect, and that should cause bigger drawdowns starting in coming weeks. So where do we put our money? It's not just these E&Ps. I think there's a very strong argument to be made for getting back into the MLP companies, and not all the MLP companies, because the companies that still have the the kickbacks to the master, to the general partners, you don't want those. But you take a look at all the companies that have converted into C corps, right? They've converted from being an MLP into being a C corp. Pretty much split the companies into two groups. The MLPs, for the most part, and there's exceptions, the MLPs for the most part kick out a big dividend, but they're really paying a lot of money to the general partnerships, and that puts that hampers them. Dave, what is that called? IDC. What are those when they have the kickback to general partner? What's that called?
I'm not sure what you're referring to.
Anybody remember what that's called? I forget the terminology. But the kickback to the general partner is what has been bad for the MLPs. Plus, growth in MLPs is about to come to a halt. In pipelines, it's hard to get a pipeline built in America. So the pipelines that are going to get built in the next 1 or 2 years, that might be it. You might not see pipelines built after about 2021. Why? If the Democrats get control of more of government, they're going to block all that stuff. So, that's their general model. They want to see fossil fuels go away over a generation, and they're not going to go away, but you're going to see it fall off a cliff at some point, probably in the 2030s, 2040s. But part of that is to make sure that oil is expensive, right? You can't encourage alternative energy if fossil fuel energy is significantly less expensive. Mm-hmm. So the two curves are starting to get to the point where solar and battery technology are getting cheaper, and they keep getting cheaper. Eventually, they'll hit physical limits too. But if we can keep the price, and I say we, but because I support this, I want to see fossil fuels more expensive anyway, because I know that hastens alternative energy, hopefully by the 2030s. You can make a lot of money on that long-range trade. So these are some big deals here, but the C corps are where you want to be. So you want to be in Enbridge. You want to be in Kinder Morgan, which was one of the first companies to switch to being a C corp, and they're finally over their problems. I like Enbridge better. And then there are several other pipelines that we're going to cover for the members, and a couple of them are going to go into the retirement income growth here, I think, very soon. And these are pipelines that are a little bit more regional specific, smaller companies, but with big payouts and huge returns on equity. So we want to take a look at that. So there's some big income generation opportunities out there. I encourage you to go to SL Advisors. This is a great article. They're actually on Seeking Alpha too. They don't publish everything on Seeking Alpha though. So what they have on their website, pretty good stuff. These charts are from a Wells Fargo presentation, and that I have laying around somewhere. So there's some good stuff out there. I mean, these just got the crap kicked out of them. I mean, we take a look at AMLP. I mean, just look at that. Just down, down, down. Not a huge downward thing, but I mean, 25%. Yeah, they've been paying out an income. So if you held this since we held it, if you just held through, the dividend, probably almost has you whole. And now we're probably going to get a rebound. But this is probably the second best group, right? These are all LPs. Where's Enbridge? Where's Kinder Morgan, right? You don't want this one. I think what you want is well, I will post that for the subscribers. There's a different ETF that's better than this one. So these guys, I think they actually might have even talked about it. They are, wow. They are short AMLP. They're long Kinder Morgan. They have another article which talks about some of the other stuff that they're long on. Well, we'll get to this. I'm gonna bookmark these guys. I like these guys. Their strategy section. So take a look here. Bookmark this one. Put it into investment firms. There you go. And then Deloitte covered this as well. Solving the capital conundrum in U.S. midstream companies. So you read this report here, and you really will come away with an understanding of the industry. And the companies that you want to buy are the stock companies that are doing buybacks and paying out a dividend and not kicking back money to a general partner. All right? That's the secret to the midstream. And then some of the refining companies. So in February of last year now, still feeling like, it's not last year yet. Just the other day I mentioned maybe start buying these. So in February of last year, 3-year chart, I told everybody that we were going to start needing to get out of these companies. So here we go. As they did this big rally, I told everybody, sell them. And I think everybody was out around here, right? Came big down. But these guys, Phillips, 66, I think probably go back up to this 100 range. Not a big jump, so I'm not too worried about that one. But there's a company out there, I think that these guys, I think Marathon, right? Marathon, interesting. I think Marathon might be the company to buy, right? I think they might be able to make a 50% run here. We'll see. Everybody who's a subscriber knows the story of Marathon, right? Who did they buy and who did the company they bought buy? So that's why I think Marathon has a pretty good run here. I think the new highs actually. And they're kicking out a big dividend. They're doing buybacks. Interesting stock. So, all right, I'm going to take about a couple seconds of questions, and then we'll call it a day because we're just over an hour. And, we pretend that that's a time limit we're trying to stick to. Dave, any thoughts on energy? I know that you did a swing trading article on it.
Right, that was Diamondback Energy. The ticker symbol is FANG,
yep.
FANG. And basically they're a good Permian play as well. And
yep.
they may have, they do have some debt, but I think, I think they should do well during a oil recovery, basically, which is what we're seeing now.
Yeah, I think FANG is a good company. All these, I think, do you really think that we can go wrong with really any of the Permian plays in the next year? I don't know we can. That's not too bad.
If oil's going up, even the companies that are and have real high debt are going to do well. It's just they're in danger. The ones that have the higher debt are in danger during the downturn, basically.
Right. So we can see that the recovery's already started. So we put some of these other companies in here. Normalize this. PXD. What is Control CXO? And kind of accidental. So basically, we can see the rebound just started, like this week. I think folks take a look at the technical charts on some of these. Take a look at the money flow. Money flow bottomed out, right? Crashed. It's as low as it gets right there. It's coming off. If we change this to weekly, what does it look like? Look at that. Starting to bend up, coming off a bottom. Could it go all the way back up to here? I think it can. I think you're going to see a huge rotation in the energy stocks. What is the acronym for when people don't want to miss out? FOMO?
FOMO, yeah.
Yeah, we're going to get some FOMO here. I think as this comes up here, FOMO starts to kick in. I think a lot of these stocks set new 5-year highs. And I don't say all-time high because some of them have been really high before. I think they almost all set new 5-year highs in the next 1 to 2 years. Huge gains to be made here. I really think you can double your money with smart option plays. And you have to have some technical skills to trade those. One of the reasons that I asked Dave to join us, because I saw that he had mentioned some swing trading ideas, and I think that's good. And the fact that he kicks everybody's ass. When you go to tip ranks and you check Dave out, you're like, wow, Kirk and Dave are kicking the crap out of people, and we do it slightly different ways. So I think we're pretty complimentary. But Parsley Energy. Oops. So I want to. You probably noticed a company on here, Parsley Energy. You're like, who's that? Kirk hasn't talked about that much. I haven't talked about that much, but I'm going to. I think that these guys are a very clear takeout candidate. They're up in the mid-30s. They're down in the teens right now. I think these guys double in price, just share price, over the next year or two, and I think they probably get bought out. These guys, for Exxon and Chevron to survive, I want to cover this for you really quick, and then we're done. They're going to have to split their companies up. They're going to have to split into upstream, downstream, midstream, and then clean. And as they do that, the drilling company, right, the exploration company, is going to have to really change how they do things. And they're going to have to go to shorter cycle and keep moving shorter cycle. That's why Exxon and Chevron have been pushing into the Permian, is they realize that's how they survive. And I don't know which part of the split, right? I don't know which one of the 4 companies that they break into is the one that gets dogged with all the debt. I suspect that they try to put all the debt on the downstream, right, on the gas stations that they own. Why? Because they probably get away with it, and those will be the first things that go out of business. And when they go bankrupt, nobody will care. What are they going to do? When have you seen shareholders actually be forward-looking enough to say, hey, you're going to screw me down the road here? No, they wait until after the fact, and then they go to a lawyer who takes 90% of the settlement that's, 90% too small. So, when these companies split up, you have to take a look and see where the executives go. And I almost guarantee you the executives end up at the clean company after they cash out with their golden parachutes from the dirty companies. But Parsley, Pioneer, all the pure plays in the Permian, they don't say they have a for sale sign up, but every single one of them has a for sale sign up. So those are the ones that I like the option plays on. So, in the next 2 or 3 weeks, we're going to have the new swing trading and option trading service available over at fundamentaltrends.com. The rebuilt one, because the old one sucks. And it's going to be pretty awesome. So if you're that type of an investor and you want to make some bigger gains, I think that that's a place where you can augment your dividend portfolio or your long-term portfolio, and it's going to be cheap for everybody who signs up early. So these are the types of trades that we're going to put out there. I will give you a free one. buy calls on parsley about $20 and get them cheap, near term, and just commit to rolling them out every couple months. And eventually, this company gets bought out. And you're probably going to just keep making money on these as the price of the shares go up. But I think that there is a big payday in this one and several others. So I promised somebody I would talk about Tesla. These are some of the portfolios we put out. Why I'm selling Tesla shares. I said this about 6 weeks ago. And Tesla cooperated. Right? Why did Tesla come down in price here recently? It's up today. But we were selling here. Yeah, right in here we were selling almost at the peak. And now it's come down about $40 a share. Why did it come down? Because as I talked about in here, they have some very specific risks. The Model 3 is going to slow down this year. The growth rates, I mean, they'll sell more, but the growth rate's going to slow. Why? Fewer incentives, and oil is still cheap, right? Maybe in the second half of the year, Tesla sales pick up at the end of the year, but I think right now this is a trading stock, and they're not over 360, and that date's coming up where they're going to have the convertible bonds that they're going to have to pay out. And he said, yeah, no sweat, we're going to pay it out. But that's going to short them $1 billion. They're going to have to dilute. They're going to have to dilute more. I'm just telling you, Tesla has to dilute more. They're not going away. They're going to stay in business forever. They're going to be a big company over time. But the share price, even at 312, I think still reflects overvalued. Down here is where I look at it, right? These big drops in Tesla are where I've been buying a couple times, but I sell on the rallies. It's been a trading stock. It's a great trading stock. You get the narrative in both directions. Hey, long term, it's going to be great. Probably. Short term, they got all kinds of headwinds and dilutions. Yep. So if you're a trader, I think you can almost make a living trading Tesla if you're really good at it. So when discussing multi-decade, last question, because I like demographics. When discussing multi-decade demographics, what about the offsets to full employment, for example, AI, self-driving vehicles, and robotics? We're going to need those. Not only as the boomers retire, right, because it's a huge generation. The generation behind the millennials is small, and the one behind that's probably going to be small. So while the millennials will largely offset the boomers, it won't be quite there because the boomers live a long time, and we have to provide them with services in retirement. It's not like they retire and die, right? They retire and then they live 30, 40 years. And so replacing them to take care of them is basically all the millennials do. So where does growth come from? So yes, automation, big deal. It's actually automation, climate change, AI, everything related with the smart everything world. That's a new website that I'm launching in about 2 months. And again, if you're with margin of safety investing or fundamental trends, you get all that stuff anyway. But it's going to be a carve out. So I think that's where the big money is, right? What was it? Get smart rich with smart everything. There you go, this one. That one. This is super important, way back in June. And this is going to be something I focus more and more on because the oil trade, sometimes is going to go away eventually. And let's see here. What about Apache? They have too many offshore assets for me. So that's why I don't like Exxon. One of the reasons I don't like Exxon and Chevron. You want to stay away from companies with a lot of offshore assets. That's just bottom line. Or in countries where there's a lot of people to bribe to get a project through, right? So keep that in mind. One of my friends was a semi-big deal in Guyana for a little while, and he told me about how the politics work there. Exxon is not going to, make as much money on those Guyana oil fields as people want to talk about. They're just not. You know, they have a lot of grease that they got to grease. So, all right, Bay Area millennials can't win. Jobs in Bay Area, but a studio costs $2,000. Yeah, we're done. But one of the things I will say, and I said this summer after I was in New York, and I said this when Amazon moved to Queens. I don't know why these companies are staying so close to these giant cities. In an age where we can do anything from anywhere, almost any time, why Apple wouldn't put something between Chicago and Milwaukee now that we got a Foxconn plant? Why Amazon wouldn't have gone to Pittsburgh instead of Washington, D.C. and New York, because there's all the open space. I don't know why these big companies keep making these mistakes of where they locate, because between telecommuting and train systems, it's not hard to go 50 miles away from that big city and just say, okay, but we want to build a rail line too and make that part of it. It's because some of these big companies are sucking so much money off of the government teat that that's going to be something that this country has to fix. These companies need to be here because they get all the protections that we offer. They have property rights. Nobody's stealing from them. We're fighting the Chinese again and trying to make them deal with things fairly. We got a competitive tax rate. You're right. The millennials have some headwinds, but I would tell any millennial, and this is something I wrote about 2 years ago maybe, don't live in the city centers. Move 20 miles away. Go to the little towns and help them build up an old downtown street that's falling apart. Because you know what? You got 4, 5, 6, 8 blocks, a mile strip in some of these cities, sometimes 2, 3, 4, 5 blocks thick. Go live somewhere where there's 30,000 people. You don't have to be next to 10 million. You can drive there in a half an hour. Take a train. So, anyway, any case. Dave, anything to wrap it up so we can really wrap it up?
Just think, stay positive. I know we got, there's a lot of headwinds out there, but and so we have some tough days in the market, but just stay positive and look out for the long term. I think everybody will be fine.
Yeah, and going full circle, back to what we started with, is the narratives tend to fit into whatever the market is doing, right? There's my dog, old cat. Sometimes the narratives don't matter. Sometimes it's just about money flow. And like I said, if the market rallies here, but the China thing and the Fed thing don't change, what does that mean about the Fed and China before? They were the reasons that people gave for the market tanking. Maybe it was just valuations, and now valuations have come back in. And at these edges of the market is where the CAPE ratio starts to make a little bit of sense. You do have to think about reversions to mean, but the reality is that I think that things are pretty good in the economy. I think the economy thinks things are pretty good in the economy. China isn't hurting things that badly. They're stimulating now over there, right? We have the ability to stimulate if we need to. Japan basically said they're going to stimulate forever. And Europe, ultimately, I don't think they tighten either. So, what does that mean? A lot of bad news has been priced in. What if the bad news doesn't all happen? What if there's some good news? What if employment stays strong? What if wages keep inching up? What if inflation doesn't rise? All those things I think are actually likely, not what ifs. I think they're likely. So I'm a stock buyer right now. I did get back into this. I called the correction, but called both corrections. I just got in too early on this one. I think that folks who buy now are going to get some great things that I already own, and you're going to get it cheaper than me. So you should be doing it. If you're not a subscriber to one of the services right now, tell you what, margin of safety is a deal right now. So I would just, even if you buy for 1 month, just follow for a month. But I think you're going to make a lot of money between now and the end of the year. I think that we're going to at least get close to the old highs. And I think there's a pretty good chance that if there's a trade deal, then we set new highs. So it's a matter of, I think the trade deal only affects whether we set new highs or just run into resistance. So I'm going to bet on a small trade deal and new highs. And my futile forecast for 2019, S&P 500 gets to 3024. There you go. How's that for a specific number? I actually have a way that I came up with that. But 3024, so between 3,000 and 3,100. Dave, what's yours? Let's make a steak dinner bet.
Let's see. Okay. Yeah, I usually don't.
I have 3,000 to 3,100. What's yours?
Okay. Let's see.
And it just has to get there. It doesn't have to finish there.
That's true. That's true. So it's kind of like the showcase showdown with the.
That's right.
Prices right.
You can go over. We'll
okay. All right.
Close this. But it doesn't have to be it doesn't have to be December 31st. Just do we get there some point during the year?
I'll say 3065.
No. I have from 3,000 to 3,100. So you got to do lower than that or higher than that.
I'm sorry.
100-point range.
That's your range. Okay. All right, so I'll go a little higher. I'll say 3,100 to 3,400. How about that?
Well, 100. You're a cheater. 100-point range. 100-point range. Pick a 100-point range.
I'm sorry. 3,100 to 3,300.
3,100 to 3,200?
200, I mean, yeah.
There you go.
I'm sorry.
So everybody, don't play poker with Dave. He's a cheater. He's a mechanic. All right. Everybody, take it easy. Have a great weekend. Do something fun. Give somebody a hug. Maybe go find a kid that doesn't get enough hugs and buy him a slice of pizza or something. Don't be the weird guy with the vandal. But, do something nice for somebody. Take it easy.
You too.